All right, let's talk about something every single business owner has to deal with, the financial tightrope walk. We're talking about current liabilities. All those short-term debts and bills that need to get paid, and paid soon. Honestly, getting a handle on these is often the difference between a business that makes it and one that doesn't. So let's dive in. So, to really bring this to life, let's meet Willow. She's an amazing chef who took her passion and turned it into a real, thriving business called the Summer Eatery. And things are going great. The place is always packed, and people absolutely love her food. But here's the thing about success, right? It brings its own set of challenges. More customers means more money coming in, for sure. But it also means more bills to pay, and they come due fast. So how does a business like Willow's, or any business really, juggle the day-to-day reality of what it owes? That is the big question. And that really is what it is, a balancing act. Because managing your short-term money is this delicate dance between the cash you have coming in and the cash that absolutely has to go out. I mean, think about it from Willow's perspective. Every time she books a big new catering gig or has a super busy weekend, that's fantastic. But it also means she needs more fresh produce, more high-quality ingredients, more supplies, maybe even more staff. All of those things create new bills that have to be paid off pretty darn quickly. That's the real tension of running a growing business. Okay, so what's the official accounting term for all these short-term IOUs? Well, we call them current liabilities. And here's the official definition. But let's just cut to the chase. A current liability is basically any debt a business expects to pay off within a year. The key word is current. It's a signal that this is a short-term thing. It's what you owe right now, or at least in the very near future. And this comparison here really clears it up. On the left, you've got your current liabilities, the stuff due within a year. Think about paying your suppliers. On the right, you've got non-current liabilities. These are the long-haul debts, like a 20-year mortgage on your building. It's all about the timeline. That's the fundamental difference. So, what does this actually look like in the real world? Let's break down 3 of the most common short-term debts that a business like Willow's is dealing with constantly. First up, we have something called unearned revenue. Now, I know what you're thinking. How can revenue be a liability? It sounds weird, right? But imagine a client books Willow for a huge wedding and pays a 50% deposit. Now, Willow has that cash in her bank account, which is great, but she hasn't actually cooked a single thing for them yet. Until that job is done, that deposit is technically a debt she owes her client. It's an obligation. And you can see exactly how this works, step by step. In step 1, the cash comes in, but it creates that unearned revenue liability. In step 2, Willow and her team do the catering event, boom, promise fulfilled. And only then, in step 3, does that liability get cleared and transform into actual earned revenue. It's a journey from being an obligation to being income. All right, next up is accounts payable. This is probably the one you're most familiar with. It's simply the money your business owes to its suppliers. For a restaurant like Willow's, this is everything. Her produce guy, her meat supplier, the company that cleans her linens, they all drop off the goods and send her an invoice to pay later. This whole system of credit is the absolute lifeblood of business-to-business relationships. And here's where it gets interesting. Managing accounts payable can be a strategy in itself. A lot of suppliers will offer terms like 210, net 30. It's kind of like a mini game for business owners. If Willow pays that invoice within 10 days, she gets a sweet 2% discount. If she waits, she has the full 30 days to pay the whole amount. So she has to choose, save a little bit of money now or hold on to her cash for a few more weeks. Our third big one is a short-term note payable. Now, unlike accounts payable, which is usually just an informal invoice, this is a formal written IOU to repay a loan, almost always with interest. And here's the really important part to get, the current portion. Let's say a bakery gets a big $100,000 loan to buy a new oven, and it's a 10-year loan. Well, the chunk of that loan that they have to pay back this year, say $10,000, that part gets classified as a current liability. The other $90,000 stays a long-term debt. Okay, so we've covered the debts that are pretty clear-cut. But what about the fuzzy stuff? The what-ifs? Businesses also have to figure out how to account for potential debts, things that might happen or might not. This brings us to a really interesting idea called a contingent liability. This is a potential future debt that all depends on some uncertain outcome. The classic examples are things like a lawsuit. You might have to pay damages, or product warranties, where you might have to pay for repairs. The key is you don't know for sure if you'll have to pay or exactly how much. So how in the world do you account for something that's so up in the air? Well, the rules are actually pretty logical. Take a look at this table. If a potential loss is both probable, meaning it's likely to happen, and you can reasonably estimate the amount, you have to actually record it as a liability on your books. If it's probable but you can't nail down a number, or if it's just reasonably possible, you just have to disclose it in the notes to your financial statements. And if the chance of it happening is remote, you don't have to do a thing. Let's make that really simple. Imagine a company sells soccer goals and they come with a warranty. From past experience, they know that about 5% of them will probably need some kind of repair, and the average repair costs about $200. See, the future cost is probable and it's estimable, so they can do the math and record that future liability on their books right now. Okay, we've definitely gotten into some of the technical details here, but let's pull back and talk about the big picture. Why does getting a handle on all this stuff truly matter for someone like Willow? It all comes down to a critical concept called burn rate. Your burn rate is just how fast your company is spending its cash. And you absolutely cannot figure that out unless you have a crystal clear picture of your short-term obligations. Even better, by actively managing those liabilities, like maybe negotiating longer to pay your suppliers, a business can actually slow down its burn rate. That gives it more time, more runway to grow and succeed. And this isn't just some internal number for the owner to worry about. Oh no. Anyone looking at the health of a business, we're talking investors, banks, even suppliers deciding if they want to work with you, they all scrutinize current liabilities. It gives them a perfect snapshot of the company's immediate cash needs, and ultimately, its ability to pay its bills on time. So if there's one thing to take away, it's this. For Willow to make the summer eatery a long-term success, being a fantastic chef just isn't enough. It really all comes down to how well she manages these short-term obligations. That financial discipline behind the scenes is what turns a passion project into a business that lasts. So I'll leave you with this thought. The next time you walk into your favorite local coffee shop or that little bookstore you love, just take a second to think about the invisible financial juggling act that's happening behind the scenes. What accounts are they trying to pay? What deposits are they trying to fulfill? What short-term debts are they balancing? Right now, just to keep those doors open for you. It's the silent engine that powers every small business out there.